In 2008, one bank collapsed, and within days, the global economy started falling apart. Lehman Brothers wasn't a small company. It was a 150-year-old financial giant, handling hundreds of billions of dollars. But behind the scenes, it was making bets it couldn't survive. And when those bets failed, the world felt the impact. This is the story of the collapse of Lehman Brothers. Lehman Brothers wasn't new. The company started in the 1800s, surviving wars, recessions, and financial crashes. For decades, it built a reputation as a powerful investment bank. By the early 2000s, Lehman was massive. At its peak, over 25,000 employees, operations worldwide, over $600 billion in assets. On the outside, it looked unstoppable, but inside, risk was growing fast. In the early 2000s, housing prices were exploding. Banks were making huge profits from mortgages. Lehman went all in. They bought mortgages, packaged them into investments, sold them globally. The more mortgages they handled, the more money they made. There was just one problem. Many of those mortgages were risky. Some were given to people who couldn't realistically repay them. But as long as house prices kept rising, nobody cared. Lehman didn't just participate in the housing market. They bet heavily on it. They borrowed huge amounts of money to buy mortgage-related assets. This is called leverage, and leverage can multiply profits. But it can also multiply losses. If housing prices fell, Lehman would be in serious trouble. By 2006-2007, housing prices stopped rising. Then they started falling. Mortgage defaults increased. Investors got nervous. Other banks began reducing exposure. But Lehman didn't pull back fast enough. They were too deep, too exposed, too committed to the bet. By 2008, financial markets were shaking. Banks stopped trusting each other. Lending slowed. Investors started asking, is Lehman safe? Lehman tried to raise money. They tried to sell assets. They tried to find buyers. But confidence was disappearing. And in finance, confidence is everything. September 2008. Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history at the time. Markets around the world reacted instantly. Stock markets fell, banks panicked, credit markets froze. Businesses couldn't borrow. Companies couldn't operate normally. Millions of jobs were affected globally. Lehman's collapse didn't just hurt investors. It triggered a global financial crisis. Governments had to step in to rescue banks. Stock markets crashed worldwide. Millions lost jobs. Millions lost homes. Entire economies slowed down. The world entered the worst financial crisis since the Great Depression. Lehman didn't fail overnight. It failed because of extreme risk-taking, too much borrowing, overconfidence in housing markets, slow response to warning signs, and one critical problem. Once trust disappeared, there was no saving the company. Lehman shows something brutal about business and finance. Growth built on risk can look brilliant until it suddenly collapses, and sometimes the biggest companies fall the fastest. If you want more real stories about the decisions that made and destroyed billion-dollar companies, subscribe to Business Files TV, because some of the biggest disasters in business history started with risks people thought were safe.